Sunday silver forecast. A major breakout is closer than you think. Right now, silver is sitting at around $67 an ounce, and most people watching that number are asking the wrong question. They're asking, is silver cheap? Is it expensive? Should I buy the dip? But the real question, the one that Wall Street analysts are quietly whispering to their clients, is this. Are we standing at the beginning of the most explosive silver breakout in a generation? Because if the math is right, if the supply data is right, if the historical patterns are right, what happens next to silver could shock everyone who wasn't paying attention. Stay with me. In the next 20 to 25 minutes, you're going to understand something that the majority of investors have completely missed. You're going to see why silver has been in a structural supply deficit for 6 consecutive years, and why that matters more than any price chart. You're going to understand how solar panels, electric vehicles, artificial intelligence servers, and even the geopolitical tensions happening right now are all pulling silver in one direction. You're going to see what the gold to silver ratio is telling us, and why that single number could be one of the most important signals in the market right now. And by the end of this video, you will have a framework that most retail investors simply don't possess. Not speculation, not hype, evidence, data, and the kind of logic that institutional analysts use when they're positioning quietly before the crowd wakes up. Let's go. Section 1. The reset nobody talked about. Let's begin where most people never look, the supply side. Silver is not like most commodities. You can't just build a new silver mine when prices rise. It doesn't work that way. Approximately 70% of all the silver mined globally every single year comes as a byproduct of mining other metals, copper, zinc, lead. What that means is that silver supply is not decided by silver economics. It is decided by the economics of entirely different industries. When copper miners slow down, silver slows down with them. When lead prices collapse, silver production falls regardless of what silver is doing. This is the invisible cage that silver supply sits inside. And here is what makes 2026 extraordinary. The Silver Institute has now confirmed 6 consecutive years of structural supply deficit. 6 years in a row where global demand for silver has outpaced everything that mines and recycling could deliver combined. Think about that for a moment. Not 1 year, not 2 years, 6 years. And the deficit in 2024 alone was estimated at approximately 195 million troy ounces. That gap was covered by drawing down finite above-ground stockpiles. But those stockpiles don't last forever. COMEX silver inventories, the exchange where physical silver is actually delivered and settled, have been under significant pressure. Coverage ratios have been declining. In plain language, that means the paper promises on silver are increasingly outrunning the physical metal sitting in vaults. History teaches us something very clear. When physical supply gets this tight for this long, eventually the price has to reflect reality. It always does. Most investors look at a chart and see a number. Smart investors look beneath the chart and see a structural story. And the story being written in silver right now is unlike anything we have seen in decades. Section 2. The demand explosion. Now let's talk about what is happening on the other side of the equation. Because if supply constraints were the only story, silver would be interesting. But the demand side is where this becomes extraordinary. For most of financial history, silver was thought of in one of two ways, as money and as jewelry. But that world is over, completely over. Today, somewhere between 55 and 60% of all silver demand comes from industrial applications. Silver is now one of the most critical technological metals on the planet. Let me give you 3 pillars of that industrial demand. Pillar 1, solar energy. Every single solar panel that gets installed on rooftops, in utility-scale farms, in the deserts of Saudi Arabia, in the fields of China, requires silver. Silver paste is used in photovoltaic cells because silver conducts electricity better than virtually any other material. There is no viable substitute for high-efficiency panels. In 2024, solar manufacturing consumed roughly 232 million troy ounces of silver. That is approximately 19% of total global silver demand from a single application alone. Now consider this. China installed more solar panels in the first half of 2025 than the rest of the world combined in the same period. The European Union has mandated solar integration in all new buildings starting in 2026. Saudi Arabia is constructing some of the largest solar installations in human history. The world is going solar, and silver is going with it. Pillar 2. Electric vehicles. EVs require silver in their power electronics, battery management systems, and charging infrastructure. Traditional vehicles use somewhere between 15 and 28 grams of silver. EVs use significantly more. And now, Samsung's new solid-state battery technology, which is already entering the luxury EV market in 2026, uses silver-carbon nanocomposite anodes that could require up to 1 kilogram of silver per battery pack. 1 kilogram per vehicle. Even a 5% market shift toward that technology would represent a demand shock the market is nowhere near prepared for. Pillar 3. Artificial intelligence. This is the angle almost nobody is talking about. AI data centers require massive, high-speed computing infrastructure. The servers, the multi-layer circuit boards, the connectors, all rely on silver-plated components to maintain the low electrical resistance that high-speed computing demands. The AI infrastructure build-out happening globally right now is quietly adding a new and growing stream of silver demand. So to summarize what we have so far, supply is structurally constrained and cannot easily grow. Industrial demand is surging across 3 transformational global megatrends simultaneously, and physical stockpiles are being drawn down year after year to cover the gap. This is not a speculative argument. This is engineering reality colliding with commodity mathematics. Section 3. The macro storm. Now let's layer in the macroeconomic dimension. Because silver is not just an industrial metal, it is also money. And in certain environments, it behaves like the most important money in the world. We are living through one of the most unusual monetary periods in history. The US national debt has crossed levels that would have seemed fictional to economists 20 years ago. Fiscal deficits continue to expand, and the Federal Reserve has been navigating one of the most complicated policy environments since the Volcker era. Right now, as we record this, silver is sitting around $67 an ounce after pulling back sharply from a high of $115 earlier this year in January 2026. Let me repeat that. Silver touched $115 in January 2026. That was not a random spike. That was the market pricing in real fear about geopolitical risk, dollar instability, and the acceleration of physical supply tightness, all arriving at the same moment. And then it pulled back. And that pullback is exactly where the story gets interesting. Because pullbacks in fundamentally bullish commodity markets are not reversals. They are opportunities. And historically, when a commodity pulls back after a structural breakout, the next advance is often steeper than the first. Now consider the dollar. When the Federal Reserve expands its balance sheet, when it injects liquidity into the financial system, the purchasing power of the dollar comes under pressure. Silver, priced in dollars, typically rises in that environment. This is not a theory. This is a pattern that is repeated across multiple cycles. And there is something else happening in the background that deserves attention. Central banks around the world, particularly in China, Russia, and emerging market nations, are actively diversifying away from dollar-denominated assets and into physical precious metals. The People's Bank of China alone has made 19 consecutive monthly gold purchases as of May 2026. What follows gold, historically, with a lag? Silver, almost always. When gold moves on monetary fear and institutional repositioning, silver eventually catches up. And right now, the gold to silver ratio tells us something important. Gold is currently trading at roughly $4,200 an ounce against silver at $67 to $68. That ratio is over 62. For historical context, during commodity bull markets, this ratio has compressed to 30, even to 15, as silver dramatically outperforms gold on percentage terms. If even a moderate compression occurs in this cycle, the math for silver becomes significant. Section 4. The geopolitical wildcard. Let's step back from the charts and the supply data for a moment, because in 2026, the geopolitical environment is adding a layer of volatility to silver that is unlike anything we've seen in years. Iran and the United States. Tensions in the Strait of Hormuz. Energy cost pressures. These events are already affecting silver. Interestingly, over the past week, silver has actually declined alongside a potential US-Iran peace deal, as investors rotated out of safe haven positions. That tells you something critical. Silver is being pushed and pulled simultaneously by two forces. The safe haven bid when geopolitics worsens, and the industrial demand ceiling when global economic uncertainty threatens growth. This dual nature of silver, part monetary metal, part industrial commodity, is precisely what makes it set up so powerful. Unlike gold, silver gets a bid from two entirely different investor bases at once. When both those demand streams converge on a constrained physical supply, the price moves tend to be dramatic. And here is the wild card most investors are completely ignoring. China. In January 2026, China began tightening silver export licenses. In a global market that was already running a structural deficit, China restricting exports of silver adds a supply shock on top of an existing supply shortage. This is not a rumor. This is documented policy. Mine production globally grows at only 1 to 2% per year. Industrial consumption grows at 4 to 6% annually. The math of those two trajectories moving in opposite directions only ends one way. Section 5. What the price is telling us right now. Let's talk about where we actually are today in June 2026. Silver is trading around $67 to $68. It has fallen roughly 40% from its January peak of $115. And the headlines are calling it a crash, a failure, a collapse of the silver thesis. But wait, even at $67 today, silver is still approximately 87% higher than it was 1 year ago. That is not a bear market. That is a bull market with a healthy correction inside it. Every great commodity bull market in history has had violent pullbacks. Oil in the 1970s, gold from 2008 to 2011, copper in the supercycle years. These were not smooth rides. They were brutal, gut-wrenching drops that shook out weak hands before the real advance. And every single time, the investors who understood the underlying fundamentals and held through the volatility were rewarded. Now look at where analysts are projecting silver prices by year-end 2026. JP Morgan projects an average of $81 an ounce. Bank of America's bull case scenario extends significantly higher. The FX Empire analysis is pointing toward $100 and beyond if momentum reasserts. From current prices near $67 or $68, even the conservative institutional targets represent meaningful upside. The question is not whether silver has a fundamental case. It clearly does. The question is always, when does the market reprice that case into the spot price? And the honest answer is, nobody knows the exact timing. Anyone who tells you they do is selling you something. But if conditions continue, if deficits persist for a 7th consecutive year, if industrial demand accelerates through the second half of 2026, if the Federal Reserve pivots even slightly dovish, historically, that combination creates the environment where silver moves fast and moves hard. Section 6. The smart money positioning. Here is something that most retail investors never consider. By the time a trade is obvious, it's usually over. When every financial news headline is screaming about silver, when your neighbor is asking how to buy silver, when social media is flooded with silver charts, that is typically when the move is in its final stages and the smart money is already distributing to the crowd. The opportunity is always in the uncomfortable middle, when the case is clear but the crowd hasn't arrived yet. Right now, in June 2026, silver has already proven it can trade at $115. It has proven the upside is real, but it has pulled back sharply. It is quiet. It is out of the headlines. Most retail investors who bought at the peak are nursing losses and have lost confidence. This is historically the setup where patient, informed investors accumulate. Mining stocks offer leverage exposure for those with higher risk tolerance. Pan American Silver, First Majestic, and the SILETF typically move faster than spot silver in both directions, amplifying returns in bull markets while magnifying losses in downturns. They are not for the faint of heart, but for the investor who has done the homework. Silver ETFs like SLV offer direct exposure without storage concerns. Physical silver coins and bars for those who want the metal itself, outside the financial system entirely. There is no single right answer for every investor. What matters is that the framework is clear, the fundamentals are real, the supply math is not going away, the industrial demand is structural, not cyclical, and the monetary backdrop remains historically supportive. If these conditions hold, if deficits persist, if the macro environment continues to pressure the dollar, history suggests silver does not stay undervalued indefinitely. Here is where I want to leave you this Sunday. 6 consecutive years of supply deficits, industrial demand surging across solar, EVs, AI, and 5G simultaneously. A gold to silver ratio that historically signals dramatic outperformance ahead. A price that is 40% off its peak, but still 87% above where it was a year ago. And a market that is quiet right now, just the way the best setups always look before they move. Markets are rarely obvious. If they were, everyone would be rich. But occasionally, if you're willing to look beneath the surface, to read the supply data, to understand the industrial demand dynamics, to trace the monetary history, patterns emerge that are impossible to ignore. The The question I want to leave you with today is this. If silver's supply deficit continues into a 7th consecutive year, if China's export restrictions tighten further, if the AI and EV build-out accelerates demand faster than anyone currently models, at what price would the market finally be forced to reflect reality? Because the correction we are watching right now may not be the end of the silver story, it may simply be the pause before the next chapter begins. Keep watching, keep learning, and see you in the next one.